Welcome to the seventh episode. And in this episode, we're going to continue on with the sixth episode of investment. And now we're going to talk a bit more about some advanced investment strategies and ultimately try to maybe maximize your returns. Again, I want to make it very clear that I'm only giving high level stuff. I'm just giving thoughts, ideas, things that work for me. I am by no means your financial advisor. I am just giving you what has worked for me in the past and just bestowing that knowledge and pitfalls and experiences, good and bad, that I've gone through that maybe you could take it, learn from it, or make the same mistakes. I don't know. Whatever you want to get out of this. So, again, I want to stress it. Always do your own research. It's always important to get to know and understand this stuff. And yeah, first thing we want to talk about, or the first thing we want to analyze, is what are advanced investment strategies? So, when I look at investment strategies, in a nutshell, I look at things where not everyone has access to do it. I look at it like investment are tiers. So the first level investment are things that 90% of the population can do, right? Houses, opening up an investment account with a bank potentially, a savings account. That's tier one. Tier two, maybe 70% of the population does. And again, don't quote me on these things. I'm just giving my analysis, so bear with me. So maybe 70% have access to this, right? Maybe initial stocks or a mutual fund, RSPs, TFSA. Like maybe TFSA, everyone has access to it. But the point is, are people leveraging it? Are that 70% actually utilizing it? Some people are not in that position to utilize these things because they're just living paycheck to paycheck and things like that. They don't even have a savings. And then you have the third tier where you're getting more into like individual trading and things like that. Not just a mutual fund that's managed, maybe an ETF that you are, looking at or you're buying, like a Vanguard or something. So that's level three. And then level four. So I think three starts at the advanced level. That's advanced level one. And then level three or level four, which is advanced level two, that's when you're getting into specific stocks, certain commodities, certain industries, forex, things like that. So that advanced level. And then the upper echelon level is like private equity, where not a lot of people have access to it. I have just gotten recently access to private equity, and I'm only allowed to put in a certain amount. So and again, that's my point. Not everyone will be approved and allowed to invest in these areas. And again, I'm only going by simple. That's what I like. So don't scream at me if you're like, oh no, of course everyone can go into private equity. The point is, does everyone leverage that? And can everyone leverage it? So I look at it like that in a nutshell. That's advanced investment. The less saturated that investment vehicle is, I look at that as the more advanced it is. I'm not giving any credence to it. I'm not saying that those people and those types of monies are better, but I'm just saying there's a cold hard reality. When the market is saturated, you have a lot of competition versus when it's closed off, less competition. And so there's newer and greater opportunities because typically the higher the risk or the less saturation, the more gain, the more potential that your money can earn for you. So, for example, does Bill Gates borrow money at the banking level, or does he borrow it at not the individual banks, but the national bank or like the Jerome Powell level, like the Treasury level? I don't know, but my point is, I'm sure Bill Gates banks different than you and I. He has so much money, he doesn't bank in that way. I was reading this thing. I'm gonna muddle it up. I forgot where I was looking at it, but and if anyone can pull it, I think it was on Instagram or something. But they were talking about how Elon Musk, right? He his company doesn't necessarily have a lot of money, or his money was in debt. His company was in debt years ago, but then he's valued at this much money. But then he technically doesn't own anything, but then he has this valuation because he has so much stock. But he doesn't technically own anything. So when he wanted to buy Twitter, he didn't have the money to buy Twitter, but he has all these stocks. And so he got a loan and got people to buy Twitter for him. Basically got a loan. But then with a loan, you need collateral to get the loan if you don't have anything. And the trick is that's how the rich do it. They leverage their stocks, they leverage all their other investments, but on paper, they own nothing. There's another one is Warren Buffett, the whole thing about how Warren Buffett pays less taxes than his secretary. Again, I don't know if this is a folk tale or whatever, but fundamentally, I understand where they're going with this. At the end of the day, when you have a lot of money, there's a lot of ways you can hide your money. There's a lot of ways you can play with your money. And so that's the idea with the Warren Buffett versus his secretary, wherein she's just an employee. Her money goes one direction, out the window, right? Because she gets paid and then the taxes are taken out for her. And then all she has left is the net amount. And what can you do with it? Obviously, hopefully you get paid a high net worth and you live well below your means. So now you can take 80% or 70% or 60% of it and invest it. But most people, do they really do that? That's what I look at as advanced strategies and advanced investment, those tier levels. Okay? And again, like I said at the top of this podcast, it's always important to do your own research. So if you hear something that sounds interesting and you like it, please do your research. Come back to me, tell me where I'm wrong. I'm learning too. I'm not perfect. And anyone that says that they have all the answers, I say you run the other way. I think at the end of the day, investing is it is when I used to do a bit of trading, there is a good saying, investing is like soap. The more you play with it, the more it dissolves. So my point is, you can't keep jumping from idea to idea. What you should do is learn from everybody, take pieces and bits what you like, and then stick with your plan. So again, I'm going to get off on another tangent. Like with trading, one of the things that they say is when trading, especially if you're doing like day trading, things like that, you have to focus on your limits. So if you have a strike point and that this thing and it's going to go up higher because you just saw a report and that report's definitely going to make it go up or down depending on whether you're hedging, whether this is going to go up, go good or bad. The point is, if you have a strike point, once you hit your strike point, you should sell or buy, whatever it is. And the reason being is because if you just keep following the money and trying to just get rich because it's going to keep going up or down in the direction that you're expecting it to go, then at the end of the day, now you're just gambling and it's guessing and you're just breaking your own rules. So the trick with investing is finding your own rules, finding your own limits, and then setting those limits and not regretting not setting them or not regretting, oh, I should have went further because I knew it was going to go up higher. No, normalize it all. Just recognize that this is a business, and just like anything, you got to set your limits, right? So I think education and doing your own research to know and figure out your own limits as opposed to following what I do or what someone else does, I think is something that you don't want to do. You always want to find your own limits and figure out your genius and what is unique to you and what works for you when it comes to your finances. And this is with anything in life. If you're dating a bunch of women, things like that, you got to stick with what you like and don't always focus on what's gorgeous and the prettiest and things like that, because sometimes these things can get away from you and then you can get lost in a lot of the options. I say at the end of the day, just try to stick with what's good, set your criteria, and stick to it. What are some of the advanced trading options? Let's talk about them. So one of them, ironically, is options trading. So Options trading pretty much is and again, I try to make this very simple. And so please don't kill me if I get it not completely wrong, but I make it too simple. Options for trading is basically you're just choosing a side, right? You're not necessarily choosing the stock itself, but you're choosing and you're deciding whether, you know what, I think this stock is going to go up or I think it's going to go down. And so instead of me actually just betting on this stock completely, I'm betting on the overall direction it's going to go. And so again, I don't remember it all. There's puts and then there's all these things. But the point is, it's a simple way for you to wet your beak into the whole world of trading. But if you don't have the amount of money to put into a stock, you could do options because I think options are a little bit cheaper. So now what you do is you can get into that stock, you can play, you can get in the game, but now you're on the sidelines. It reminds me of roulette. With roulette, you could, ironically, I talked about you don't want to, you, I analogize stocks and doing it in a way that's gambling, but follow me. So it sort of reminds me of roulette where you could either choose a number because you know this number and you have a good feeling about this number and you want to invest in this number. And so you're going to choose number 85, for example, and you're going to put and stake your money on 85. That's your stock, right? And then the ball spins on the roulette table. And then if it hits 88, you're good, or 85, whatever I said, you're good and you are up quite well. Or what you could do is you can just bet on the side where now you're not choosing a number, but you're choosing whether the number will be even or odd. So it's an option. You're not necessarily choosing a specific stock or a number on the board, but you're choosing whether it's going to be either a red number or, sorry, an even number or an odd number. And so what happens there is the odds are you're not going to make as much money had you chosen an actual stock or number on the board, but at least you're choosing something. And if you do hit, and then your probability is your probability of winning or hitting or your stock earning you something as opposed to losing it completely is a lot less because you're 50-50. I don't know if it's 50-50 exactly, but the point is you're less likely to be wrong than you are to be. You may be right or you may be wrong. It's a 50-50 chance in a sense. Versus if you put your stock or your chips on a specific number, there is a specific percentage of 0.523% that roulette number is gonna or that ball's gonna land on your number. But again, the greater the risk, the greater the reward, because as much as there's a 2% chance, you can potentially win 80% of your money back. Versus with you betting on the side or options, you'll probably only make max amount, maybe 50% of your money. So that's how it is. It's a give and take. So that's options trading. And then you have futures and commodities. And so basically that's basically betting on the future of companies and our economics and things like that. And then also it's betting, and then it's not betting, but you're just investing in these areas. It's a part of the stock market, futures. And then you have commodities where you're investing in farm or cattle. I'm drawing a blank here. Grains, things like that. Gold, for example, things like that. So you have that. And then you have real estate, REITs, so real estate investment trusts. So basically what that is, if you don't necessarily own houses or you don't want to own houses, you can own REITs or basically real investment trusts, and then you can invest in those. And so though you don't necessarily own a physical house, but you're investing in a trust. And then when that trust goes up and down based off of the economics or the current landscape of our economy, then you gain there. And again, you can invest and grow in that way. And then of course, one that's a little bit more, not necessarily more accessible, but you have dividend growth investing. And so again, this is where you can strategically buy blue chip stocks or certain type of stocks, or you can do it any type of way where the whole name of the game is that you start earning from dividends of stocks or companies that give out dividends at very high amounts, or at least as high as possible. And so you're making money as fast as possible back from those investments because you're focusing on companies that give out dividends, but also give out dividends that are in a high percentage. And then of course you have peer-to-peer lending. And so peer-to-peer lending is when you basically lend to your friends and family and things like that. And obviously, with all of these, there's different types of risks. So always be careful of that. And then you have cryptocurrency. Cryptocurrency is one of the hot ones or popular ones now. Very volatile, but that's when you invest in a digital currency like Bitcoin or Ethereum and things like that. You could also mine it, but then again, that's still a cost because you gotta deal with electricity, you gotta have a powerful PC to do it, and things like that. And one thing I was actually thinking about, never really heard about it until recently, but assisted purchase program. It's basically allows for people to rent to own houses. Don't know much about it, but I just heard about it. I'm learning more about it, stuff like that. I guess that delves into the private equity type things, I think. But ultimately, the whole idea is as an investor, you would work with a broker that's working with a couple or a person that is trying to buy a house, but for whatever reason, that person either maybe they have no credit history, they're a new immigrant, stuff like that. But the idea is that they do have a high income, like maybe they make 100,000 a year, but they just can't afford or they can't get approved for a mortgage. So the idea is that me as an investor have a good credit score, I'm a citizen, I can now purchase the house for them. And then now what they will do is they will take over the payments of the mortgage because I purchased it for them. And then after they would also put put a bit towards saving up for the down payment so they can eventually in a couple of years buy the house off of me. And then I guess maybe I get a little bit of kickback as the investor per month from, from them for my troubles. And so that's another way you can invest. Again, I look at that as an advanced investment because it sounds risky because if the renter that you bought the house for eventually abandons or decides, you know what, I don't want to rent this house anymore, then you're the one on the hook because you bought the house technically. Yeah, so that's what I look at as uh, different types of advanced strategies for investing. Now, with any type of events or any type of investment, there are risks. And so, what are some of the ways that we can mitigate the risks of these investments? One way is definitely diversification. So, I think I talked about this in one of the other podcasts, and again, I'm just giving an example. If you're in tech stocks, buy some gold too. And the idea is, and again, I don't know if there's a correlation, but my point is, if tech goes down, usually gold goes up. So the point is you want to diversify your assets so if tech drops, at least your gold goes up. And so the idea is that you ultimately don't lose out in the long run or you're hedging against those losses. And then dovetailing to the next one, hedging. So hedging is basically ultimately protecting the potential losses. So that's where you can do certain type of tax strategies or do tax mitigation. Just like what I said, diversifying to the point where one stock cancels out the other stock or hedging against the two. And then you have a risk tolerance assessment. And again, I think I talked about this as well. My risk tolerance is quite high. I'm at probably like a 9.9 out of 10, where 0 or 1 being no risk and or little to no risk, and then 10 being the ultimate risk, potentially losing it all. I definitely would be in a 9, right? 9 out of 10, maybe 8.5 out of 10, but I'd rather just 9 out of 10. And it's simply because insulated myself. I have enough resources. Again, I don't necessarily have a traditional safe or savings or safety emergency fund, but at the end of the day, I've always lived below my means, so there is money in the bank there. Again, I have nothing against emergency funds. It's just I would rather just keep my money in investments as opposed to just a high yield investment account. I'd rather put into a low yield investment as opposed to a high yield checking or savings account with the bank and call that my emergency. I'd rather put it into a bond or something like that. So that's just it, right? But I digress. Those are pretty much the risks, ways that you can manage your risk. And one of the things I think everyone should always do, if you're new to investing and you're not quite sure you want to actually play with real money, always take advantage of some of the big banks. They typically have a an investment, what's the word? Investment simulations. They don't want you to lose your money any more than you want to lose your money. That's because they know if you lose your money, then they cannot make fees off of you, and then you're going to probably pull your money out of their account, out of their bank. So with TD, I think they have something called Thinkorswim. I used to use that a bit back in the days when I was doing a little bit of trading. So it's called Thinkorswim. It's basically a platform where they give you fake money and it's a stock market, but I think it's either 5 hours behind or a day behind or whatever. So it's not real time stocks, the stock market. But the point is, you can make legitimate, using virtual money, purchases of stocks and ETFs or whatever is on the market. And then you can see how your stocks would have done and performed had you used real money. Again, it's delayed, it's not real time, but the point is it can give you give you insight if your selection of stocks is working for you or working against you. So that's something that I always like to use if you can. Just learn, and then also to allow you to try to, force you to understand candlestick charts and things like that and the different types of emergent patterns. Again, I'm getting to stocks and stuff a bit, but that's basically what Thinkorswim is. It's basically allows you, if you want to start trading and practicing your stock picking and selection, you can use that. Another thing you can do is you can get on the penny stocks. I had a friend that used to do this a lot, and the whole idea there is that there's a whole index or a whole market of companies that are below the Fortune 100 or Fortune 400, I don't remember. But the point is they're on their own stock market and they're basically not on the main markets like Dow Jones, TSX, S&P 500, all that stuff. They're on a lower market. And what you could do is I forgot what app I used to use, but there's apps that you can purchase that will connect you to that market. And then you can now buy things at such a small amount. So you can buy like stocks for $5. You can buy 5,000 shares for for a company that's up and coming, that's on the penny stock market. And yeah, $5 you can buy 5,000 shares. So you could do that as well. And just for personal development on that angle, patience and discipline. I truly believe that anything that's worth anything, you got to take your time with it and hack yourself. So me, I don't like to read a lot. What I'll do is I'll look at a lot of videos, a lot of eclectic videos. I try not to look at videos on a topic that is in a group thing. I like to look at a bunch of different videos that are not in a group thing, but on the same topic or subject. And so I do recommend that you guys do that. Find your own path and find your own way through this stuff. Because it's fun ultimately, but it can be a little tiresome and troublesome in the beginning. And then just emotionally control. So for me, I'm a little bit of a hypocrite that way because all my investments, I have to feel them. I don't know, that's just me. So all my houses, there's a history behind it. There's a story behind the house, why I got it, what's the purpose, versus You look at a real hardcore investor, it's location, right? They're building a school in 2 years and I want to rent out to students or things like that. They just opened up in this area. Bylaw was just unlifted. So now you can renovate the basement in this way. So there's all different benefits of having that control emotionally with respect to your investments. And I think I'm going to stop it here. Hopefully you learned a lot. Again, I hope this is great for you. I definitely learned a lot. Oh, I didn't. But no, I look forward to any comments, thoughts, any type of advanced strategies or advanced investments that I might have missed. Please, I want to know. Maybe I missed something. I'm not saying this was an exhaustive list. There's definitely always different ways to invest and much more ways to invest than what I've said. But there's glaringly obviously one that I missed. Please call it out. I would love to hear from you. So once again, thank you, signing off, and God bless.